You know, when you think about stone and tiles, you probably imagine something rock solid, right? Permanent, stable. But if you actually peel back the layers and look at the industry behind these materials, well, you find a completely different story. It's one full of surprising chaos, incredible cost pressures, and companies just scrambling to find some solid ground.
Okay, so here's how we're going to tackle this. First, we'll look at the big picture numbers to see what's really going on. Then, we're going to dissect the costs to figure out why things are so unstable. After that, we'll get a view from the top, hear what company leaders are doing to survive. We'll weigh the risks versus the opportunities, and then we'll wrap it all up with a final outlook for the whole sector.
So let's kick things off with the top-line data. And honestly, it paints a pretty worrying picture for the stone products category.
The first number that just jumps off the page is this one, a huge drop in operating revenue. I mean, across the companies we looked at, revenue fell by a staggering 25% in just the last fiscal year. For an industry that's supposed to be built on stability, a hit that big is a major, major red flag.
And this chart, wow, this really shows you the challenge. We're talking about instability. Profit margins have been on an absolute roller coaster. Look at this, from a deep, deep hole at -18% to a quick recovery up to +11, only to fall right back into the red at -6%. So this isn't just one bad year, it's a sign that the whole business environment is fundamentally volatile.
So, what in the world is causing these wild swings? Well, to get that, we've got to look under the hood at the industry's cost structure. And that's where you find some serious pressure points.
Now, this breakdown is really revealing. You can see right away how just a couple of key expenses are totally dominating the finances. Yeah, the cost of materials is the biggest piece of the pie at 43%, no surprise there. But it's that next item on the list. That's the one that tells the real story of the pressure these guys are under.
Utilities. We're talking about electricity and fuel. They have absolutely exploded, now making up 36% of total expenses. Think about that. That eats up a huge chunk of every single dollar that comes in and makes all those energy-heavy processes like firing tiles in a kiln a massive financial weak spot.
And it doesn't stop there. Just the cost to move these heavy, bulky materials around is also climbing, now accounting for almost 7% of expenses. So you've got this dual pressure of crazy high energy costs and rising transport costs, and it's just squeezing margins from both ends.
So how are company leaders handling all this? When you read through their management reports, you can really see them grappling with these challenges in real time. And you know what? They're taking some very, very different paths just to survive.
First, let's take a look at Lexus Granito. Their revenue dropped by over 36%, and they're still operating at a loss. So what's their response? They're changing the very product they're known for.
Right there, in their own words. Their bet is all on volume over value. They're pivoting to budget-friendly tiles, hoping they can just capture a bigger piece of the market and find their way back to being profitable, even if it means they make less money on each individual sale.
Now, Ravalila Granites is taking a totally different approach. Instead of changing what they sell, they're changing who they sell to and where they are. See, they saw the writing on the wall with all the tariff risks in the US and decided to proactively shift their focus to Europe. It's a strategic move to sidestep those messy trade disputes and plug into more stable construction markets. It's a classic geographical pivot to de-risk the business. Smart.
But not every story here is one of clever adaptation within the industry. Nithi Granites, well, they offer a pretty stark warning about just how intense these pressures really are. After struggling in their main business, selling granite, management basically decided to pivot right out of the industry, completely. They're now focusing their resources on financial trading. I mean, let that sink in. When a company decides it's more viable to trade stocks than to sell stones, that tells you a whole lot about the health of the entire sector.
So you can see it, right? This whole industry is at a major crossroads. It's fighting some significant headwinds, for sure, but there are still potential ways to grow for the companies who can figure out how to navigate all this.
So on one side, you have all the risks. You've got fierce competition from man-made materials like quartz, you've got unpredictable tariffs, stricter environmental rules, and raw material prices that are all over the place. But on the other side, there are some real opportunities. You've got huge infrastructure projects in emerging markets, a booming home renovation trend, a growing demand for sustainable and ethically sourced stone, and even new openings created by restrictions on some of those engineered competitors.
So what does this all mean for the future of the stone and tiles industry?
When we connect the dots between the volatile finances, those crushing costs, and these different companies' strategies, a pretty clear picture starts to emerge.
Okay, first, that margin pressure from high energy and logistics costs, it's severe, and it is here to stay. Second, standing still is just not an option. Making a strategic pivot is absolutely essential for survival. Third, those external threats like trade policy and competition from synthetic materials, they aren't some distant problem anymore. They're here, right now. But finally, it's not all doom and gloom. There are pockets of growth, especially in renovation and new markets, but only for the companies that are agile enough to grab them.
And all of this leaves us with one final critical question. The stone industry has always relied on its reputation for being timeless, durable, and naturally beautiful. But in a world of rising costs and innovative new competitors, is that legacy going to be enough to build a truly solid foundation for the future?